All right, CA Inter students, let's talk about material cost. You know that one chapter you think is easy marks? Well, it's actually packed with hidden traps that ICAI loves to set. Today, we're going to dismantle this chapter piece by piece, so you can walk into that exam and absolutely ace it. Ready? Let's dive in. You know that feeling, right? You walk out the costing exam, feeling confident. You nailed that big material cost question. You know you did. But then the results come, and you're down 3, maybe 4 marks on that exact question. It's gut-wrenching, and it happens to so many students. The big question is, why? Well, the answer is always in the fine print, isn't it? ICAI isn't just checking if you can use a calculator. They're testing if you understand the rules. Did you accidentally add in those demerge charges? Did you mess up the treatment of a returnable container? Or did you fall for the oldest trick in the book, the cash discount trap? These little details, they're the difference between a decent score and that exemption you're aiming for. So let's start at the very beginning. Because before we even think about touching a calculator, you have to understand the why. Why do we obsess over controlling material costs? It's not just about the numbers. It's about the entire health of the business.
First up, a super quick refresher on the absolute basics. You've got 2 kinds of materials. Direct materials. Think of the wood used to build a table. You can literally point to it and say, that wood is in that table. Its cost is directly traced. Then you have indirect materials. This is the glue, the nails, the sandpaper. Yeah, they're essential, but you can't really figure out how much glue is in one specific table. This simple distinction is the foundation for everything we're about to cover.
Now, you might be asking, okay, but why is this such a big deal? Well, think about it. Material control affects pretty much everything. It impacts the final quality, the price you can sell at, and it makes sure the factory assembly line never grinds to a halt because you ran out of one tiny screw. It's this constant, high-wire act between holding too much stock and the disaster of running out. Get this wrong, and the whole company feels the pain. So, when we use the term material control, it's really just a system with 2 simple goals. Goal number 1, keep the factory running. No matter what, production should not stop because you're missing materials. Goal number 2, do it as cheaply as humanly possible. That means getting the best purchase price, minimizing ordering costs, and not spending a fortune storing the stuff. Okay, so how do you actually control all this? You can't just wing it. You need a system. And that system runs on documentation, a paper trail. Now, this isn't just boring theory. This is exactly how massive companies manage millions and millions of rupees in inventory. For your exam, you have to know who makes what document and why. Check this out. This flowchart is basically the life story of every single nut and bolt in a factory. Think of it as our map for the next few minutes. We're going to follow the entire journey, starting right at the top, where the whole idea is born. Every great product starts with a recipe, right? Well, in manufacturing, that recipe is called the Bill of Materials, or BOM for short. Before anything gets ordered, the folks in the engineering department create this master list. It's the blueprint, detailing every single component needed to make the final product. So, the BOM is the cookbook. But what happens when the chef, that's the production department, is actually ready to start cooking? They don't take the whole cookbook to the pantry. They write a specific shopping list for the dish they're making right now. That shopping list is the Material Requisition Note, or MRN. It's the official request to the storeroom to please hand over the materials. And right here, this is a classic ICAI theory question. They absolutely love to ask this. If the BOM is this perfect, complete list of everything you need, why do you need a separate Material Requisition Note? Can't you just use the BOM instead? So what's the verdict? And you need to be crystal clear on this. Yes, a bill of materials can be used in place of a requisition. But, and this is a big but, a material requisition note can never replace a bill of materials. Let's break down why, because this is where marks are made. The BOM is the plan. The MRN is the action. The BOM says what you're supposed to use. The MRN records what you actually used. That's a huge difference for control and costing. Okay. But what if the production team asks for something from the stores, and the storekeeper looks at the shelf and it's empty? That's when the storekeeper fills out a purchase requisition. It's basically a formal shout out to the purchase department saying, hey, we're running low on this, go buy some more. This is the document that officially starts the buying process. And that purchase requisition is the starting gun. As soon as it lands on their desk, the purchase department kicks into high gear. Now it's their job to make some really important decisions. The entire job of the purchasing team really boils down to answering these 5 simple questions.
What exactly are we buying? When do we need it by? How much of it should we get? Who are we going to buy it from? And, of course, the big one, what price are we going to pay? Get these right, and you're saving the company a ton of money.
Now, here's a little nugget for you, a real exam tip. When it comes to picking a supplier, especially for a government company or a PSU, it's not just about getting the lowest price. The whole process has to be squeaky clean, completely transparent, and fair to everyone. Why? Because you're spending public money, and you have organizations like the CVC and the CAG watching everything. The key phrase to remember here is equality of opportunity. It's perfect for a theory question.
All right, let's fast forward. The order's been placed, the deal is done, and the supplier's truck is backing up to the factory gate. Now we get to the part you've been waiting for, the calculations. This is where the marks are really won or lost, so pay close attention.
So when that truck arrives, the team at the receiving dock doesn't just sign a piece of paper. They inspect everything. They count the items, check for damage, and make sure it matches the order. If it's all good, they prepare a goods received note, or a GRN. This document is absolute gold. It's the official proof of receipt, and it's the green light for the accounts department to finally pay the supplier. And here it is, the golden rule of material valuation. You need to burn this formula into your brain. The total cost of your purchase is not just the price on the invoice. It is the invoice price plus all the other expenses needed to get it to your factory, minus any trade discounts. This framework is a foundation for everything that comes next.
All right, this slide right here, this is the minefield. Let's be crystal clear. What do you add to the cost? Things like freight inwards, insurance, and any taxes that you can't get a credit for. Yes, add those in. Now, what do you ignore? First, the big one, the classic ICI trap. Cash discount. Do not subtract it. It's a financing cost for paying early, not a reduction in material cost. I repeat, it is a financing cost. Next, things like demurrage or late fees. Those are abnormal costs. They go straight to the costing P&L, not your material cost. And finally, containers. If it's non-returnable, add the full cost. If it's returnable, you only add the portion you don't get refunded. This is absolutely crucial.
Okay, we're in the home stretch. We've ordered the material, received it, and valued it correctly. But, things aren't always perfect. What do you do when stuff is missing or you have to send something back? So let's say you've already made the GRN, it's all in your system, and then you discover a defect. You can't just put it back on a truck. You need another document called a material returned note. This is the official paperwork to send materials back to the supplier, and more importantly, to make sure your own accounting records get corrected.
And here we have another huge exam trap, shortages. How you handle a shortage depends entirely on one question. Is it normal or is it abnormal? If it's a normal shortage, like a little bit of evaporation, something you just can't avoid, you take its cost and you spread it over the good units you still have. You basically just inflate their cost per unit slightly. But if it's an abnormal shortage caused by carelessness or theft, that cost is a big problem. It is never added to the cost of your good materials. Instead, you treat it as a loss and send it straight to the costing profit and loss account. Get this treatment wrong, and your final answer is guaranteed to be wrong.
Material cost. We're going to nail down storage, records, and inventory control so you can walk into that exam with total confidence.
Okay, quick gut check. Picture it. You're in the exam hall and a question pops up. Can you, right now, without hesitation, tell me the exact difference between a bin card and a store's ledger? No fuzzy ideas, I mean the precise marks-getting differences. It's a classic trap, and honestly, it's where so many easy marks just vanish.
Hey, if you paused for even a second, that's okay. That's why we're here. Because this stuff, it's not just boring theory. It's the kind of detail that can make or break your score. So let's do this.
Okay, first things first. We have to establish control right at the source, where all the materials live. This is step one, the storekeeper's domain.
So, who's our person on the ground? The storekeeper. Now, don't think of them as just a guard. They're the frontline commander in the war against inventory chaos. They control the store, they keep materials safe, and they track every single thing that comes in and goes out. But here's the exam-critical part you have to remember. It is the storekeeper who kicks off the buying process by raising a purchase requisition when stock hits that reorder level. They are the ones walking that tightrope, making sure we don't run out of stock but also don't have too much capital tied up.
All right, we have our person in charge. But how do they, and how do we, know what's going on? You can't control what you can't measure, right? That brings us to our second tool, gaining total visibility with the right store records.
Now listen up, because this is an ICI favorite.
There are 3 records you've got to know cold. First, the bin card. It only tracks quantity. That's it, just the numbers. And the key is, it's physically in the store, attached to the bin, and the storekeeper updates it. Second, you've got the stock control card. This is also a quantity-only record, and it's also kept in the store. You can think of it as a central summary of all the different bin cards. And third, the big one, the store's ledger. This is the odd one out. It tracks both quality and value, and it is not in the store. It's in the cost accounting department. This difference is everything.
So you might be asking, why have both a bin card and a stock control card? Well, it's all about trade-offs. The great thing about bin cards is that you update them right then and there so you get fewer mistakes and you can instantly compare the card to what's physically in the bin. The downside, you've got records scattered all over the warehouse. They can get lost or dirty. It's messy. The stock control card solves that. It's all in one place, it's clean, and gives you a nice summary. But it makes that quick physical check much harder. It's a practical choice.
Okay, team, eyes here. If there is one slide you need to burn into your memory, it is this one. This is where marks are won and lost. Period. Let's nail this down. Location, bin card, in the store. Store's ledger, costing department. Got it? Content, bin card, quantity only. Store's ledger, quantity and value. Posting time, bin card is done right away, in real time. The store's ledger gets updated later. And finally, detail. Every single little transaction goes on the bin card. The store's ledger, it can be posted with summary totals. You have to know these 4 differences.
Great. We've got our person on the ground, and we've got the records for visibility. Now it's time to think bigger. What's the whole point of this? That's tool number 3, the inventory control objective. Our strategy.
You know, the official definition from SEMA is all about having enough stuff but not too much stuff. But let's simplify that. The entire game of inventory control is a balancing act. It's a tug of war. On one side, you have the cost of running out of stock. Your factory stops, customers get angry, you lose sales, that's bad. On the other side, you have the cost of having too much stock. Your cash is locked up, you're paying for a huge warehouse, and things can get old or damaged. That's also bad. Our job is to find that perfect sweet spot right in the middle.
All right, strategy is set. Now it's time to get our hands dirty with the numbers. This is the engine that makes our whole system run. Let's dive into tool number 4, mastering the inventory level formulas.
First up is the reorder level, or ROL. Super simple concept, it's the trigger point. When your stock drops to this level, you shout, hey, time to order more. Now, exam tip, right here, pay attention. There are 2 formulas for this, and ICAI expects you to know both. The first one is the worst-case scenario formula, your maximum possible usage times the maximum possible delivery time. But they can also ask for it this way, your minimum level plus your average usage during the average delivery time. Don't get caught out, know them both. So, now we need to set our guardrails, a floor and a ceiling. The minimum level is your safety net, your buffer stock. We calculate it by taking our reorder level and subtracting the normal amount we'd use during a normal delivery time. Then there's the maximum level. This is the absolute ceiling. We don't want to go above this. The formula? It's your reorder level plus the new stock you just ordered minus the smallest amount you might use in the shortest possible time. Just watch out for that little switch from average in the minimum formula to minimum here. That's a classic tripwire.
And there are just a couple more. Average stock level is easy. It's just your minimum level plus half of what you order each time. But this next one, danger level, is critical. This is below your minimum level. This is the red alert level where you stop normal work and only give out materials for absolute emergencies. You find it by taking average usage and multiplying by the time it takes to get an emergency rush delivery. Don't mix it up with the minimum level. Danger level is the real panic button.
Okay, let's make this real with an example. We've got 2 parts, A and B. We're given all the data, normal, max, min usage, how much we order, and the delivery times. Now here's what you do in the exam hall. Before you even think about a formula, just scan the table and pull out the key numbers. For component A, what's max usage? 75. What's max period? 6 weeks. For B, what's min usage? 25. What's min period? 2 weeks. Get your variables sorted first, then you can relax and just plug them in.
And here are the answers. Let's just talk through one of them. Say ROL for component A. The formula is max consumption times max period. So we take 75 units a week, multiply by the max period of 6 weeks, and boom, 450 units. Easy, right? Let's do the minimum level for A. That's ROL 450 minus average consumption times average period. Average consumption is 50. The average of 4 and 6 weeks is 5 weeks, so 50 times 5 is 250.
450 minus 250 gives us 200 units. See, it's just about calmly applying the formulas. All right, time for our final and, I think, most powerful tool. This is the one that really hits the bottom line and saves the company a ton of money. Let's talk about the economic order quantity, or EOQ, finding the absolute most cost-effective order size.
So what the heck is EOQ? It's the magic number. It is the perfect quantity to order each time so that your total costs related to inventory are as low as they can possibly be. To find it, we have to understand that same tug of war again. On one side, you have ordering costs, the admin costs, delivery fees, etc. for placing each order. On the other, you have carrying costs, the cost of storage, insurance, and the risk of holding inventory. EOQ is that perfect point where these two costs are in balance.
This graph just explains it perfectly. Look here. As your order size gets bigger, your ordering cost line goes down, right? Because you're placing fewer orders per year. But at the same time, your carrying cost line goes up because you're holding more stock on average. The total cost is that U-shaped curve, and the EOQ, it's that lowest point on the curve, which, no coincidence, is exactly where the other two lines cross. That's our target.
Okay, another theory alert. ICAI loves to ask about the assumptions behind the EOQ formula, so you need to know these. The model assumes a few things that aren't quite real life. It assumes ordering cost and carrying cost are fixed. It assumes you know the demand for the whole year in advance. It assumes the purchase price never changes. And the big one, it assumes you get your delivery instantly, a lead time of 0. We know that's not true, but these assumptions make the basic calculation possible.
So let's run the numbers. We need 10,000 kilograms for the year. That's our A. The cost to place one order, our O, is 50 rupees. And the cost to carry 1 unit for a year, our C, is 8% of the 2 rupee cost price, which is 0.16. So we plug it in. It's the square root of 2 times A times O divided by C. Punch that in, and you get an EOQ of 2,500 kilograms. And how many orders is that? Just take your total need, 10,000, and divide by your order size, 2,500. It's 4 orders a year.
Now this is why we do all this math. Look at what happens when the purchase price changes. The price drops from 20 down to 12.80. Because our carrying cost is a percentage of that price, our carrying cost, C, also drops. Now think about it. If it's cheaper to hold stock, it makes sense to hold a little more, right? And that's exactly what the math tells us. Our EOQ actually goes up from 200 units to 250. And the result? Look at the total cost. A massive drop. This is how you use costing to make smart business decisions.
What comes to mind? EOQ, reorder levels, FIFO, LIFO, right? But where do you think most students actually lose marks? I'll give you a hint. It's not the big, complex formulas. It's a tiny little detail that the examiner uses to trip people up, and it can cost you the whole question. Any ideas what it might be?
It's this, right here. The difference between normal and abnormal material losses. It seems so simple, doesn't it? But get this one little adjustment wrong, and an easy 8-mark question goes straight to 0. I'm not kidding. This is one of ICAI's favorite traps. And by the time we're done here, you're going to know exactly how to spot it and avoid it every single time.
All right, let's get started. First up, we're looking at a modern philosophy that pretty much turned inventory management on its head. I'm talking about just-in-time, or JIT.
So, what's the big idea behind JIT? It sounds kind of crazy, but it's simple. The goal is to have 0 inventory. Just think about that for a second. No giant warehouses, no cash locked up in stock just sitting there, no paying for storage. With JIT, you buy materials only when you actually need them for production. It's all about being lean and super efficient.
How does it work? Well, JIT uses what we call a demand pull system. The whole thing is kicked off by the customer. A customer places an order, and that's the signal that pulls everything forward. That order triggers production to start, which then tells the purchase department to buy materials. The materials literally show up from the supplier and go straight into production. See? Just in time.
Okay, that sounds great. But what if you're a massive company with like thousands of different items in your inventory? You can't possibly watch every single screw and washer with the same level of intensity. That would be impossible, right? And that's exactly why we have selective inventory control techniques. They help us work smarter, not harder.
And the big one, the one you absolutely have to know, is ABC analysis. Now listen up, because this is a favorite ICAI exam question. ABC analysis is based on the total annual consumption value. Let me repeat that. Total annual consumption value. That's the quantity you use all year times the price per unit. It's not based on just the unit price. So many people get this wrong, and it's an easy mark to lose. Don't let that be you.
This graph shows it perfectly. ABC analysis is really just the Pareto principle. You know, the 80-20 rule applied to our stock. Look here, you've got a tiny number of items, your A items, that make up a huge chunk of the total value. And on the flip side, you have tons and tons of C items that when you add them all up are worth very little. It's all about focusing your energy where it matters most. Okay, this table right here, you need to burn this into your memory. It's crucial for both practical sums and theory questions. Seriously, pause and take a screenshot right now. So, A items. They're roughly 10% of your total stuff but account for about 70% of the money. These are the ones you need to control very, very strictly. Then you have C items, 70% of your items, but only 10% of the value. For these, a simple, loose control system is perfectly fine. And B items? Well, they're just in between.
Now, ABC isn't the only game in town. There are a few others you should know. There's VED analysis, which is all about how critical an item is for production. Is it vital, essential, or just desirable? Think about it. If a vital spare part isn't there, the entire factory could shut down. Then there's HML analysis. This one's much simpler. It's just based on unit price, high, medium, or low cost. The key is not to get them mixed up in the exam. Oh, and you might also see FSN analysis, which is about how fast-moving the items are.
So, we've got all these cool control techniques, but how do we know if they're actually working? How can we measure if we're doing a good job managing our inventory? Well, that's where performance ratios come in.
First up is the input-output ratio. This one is all about efficiency. It basically asks how much material did we use versus how much material should we have used to make what we made. If that ratio isn't looking good, it's a major red flag. It's screaming at you that you're either using too much material or wasting it somewhere along the line. Next, we have a real classic, the inventory turnover ratio. You've got to know this one. It tells you how fast your stock is moving off the shelves and into production. A high ratio is fantastic. It means things are flying. But a low ratio? Oh boy, that's bad news. It means your cash is just sitting there, gathering dust in the form of unsold stock. Management hates it, auditors flag it, and it's a sign of a big problem. Okay, let's switch gears and get into the real nitty-gritty of the practical problems you'll see in your exam. We're talking about how we put a price on the materials we use. This is where you'll see those familiar friends, FIFO, LIFO, and the weighted average method.
Let's break them down. FIFO is first in, first out. Pretty simple, right? It's like a queue at the grocery store. The first one in is the first one out. This means your closing stock is made up of the newest stuff you bought. LIFO is the opposite. Last in, first out. The most recent stuff you bought is the first stuff you use, which leaves the old stock sitting in inventory. But, and this is a huge but, there's a critical difference between them that you must know for the exam.
Okay, everybody, listen very carefully. This is a massive exam tip. I need you to hear this loud and clear. LIFO is not, I repeat, not permitted under Accounting Standard 2 on valuation of inventories. Now, ICAI might still give you a question and ask you to calculate using LIFO just to test your knowledge, but you have to know in your head, and write it down if you get a theory question on it, that for real-world financial reporting in India, it's a no-go. I guarantee you people lose marks on this every single year. Don't be one of them.
All right, let's check out the weighted average method, or WAM. The key thing to remember here is that you only recalculate the price when new stock comes in. You don't do it for every issue. So look here, on September 9th, we get a new delivery. Bam, the rate changes from 285 to 276.54. So when we issue stock the next day, we use that new rate. Simple enough? But now, direct your attention to the very last two entries on September 30th. This is it. This is where the trap we talked about at the beginning is hiding.
And boom! There it is. This is the big reveal. This is that classic trap that costs students so many marks. Look closely at the difference. The abnormal loss, that's the unexpected stuff, like a fire or theft, is treated just like a regular issue of stock. We give it a value, and that cost gets booted straight to the costing P&L account. It's gone. It doesn't touch the value of our good inventory. But the normal loss, the stuff we expect to happen, like a little bit of evaporation, is totally different. We give it zero value. Instead, its cost gets soaked up or absorbed by all the good units that are left. And what does that do? It actually inflates the cost per unit of the remaining stock. Getting this one treatment right can be the difference between passing and failing a question. It's that important.
Okay, now that we've nailed that, Let's quickly round out our knowledge by looking at a couple of other types of losses and spoilage.
So, you've got spoilage. These are items that get damaged during manufacturing and can't be saved. And just like with material losses, how we account for it depends on if it's normal or abnormal spoilage. Then you have defectives. These are items that aren't perfect, but we can fix them. The cost of fixing them, the rework cost, depends on why they were defective in the first place. Finally, there's obsolescence. This is when your stock becomes old news, maybe because of new technology. That loss in value? It usually gets charged directly to the costing P&L.
And just so you know the full picture, there's a proper procedure for all this. It's not just random. The production guys can't just walk into the storeroom and grab stuff. First, a foreman has to fill out a material requisition note. It's like a permission slip. Then, the stores department issues the materials based on that authorized note. At the end of the day, all these notes are summarized into one big report called a material abstract or a store's ledger. And that summary is what's used to charge the material costs to the right job or department.
You know, after all that, JIT, ABC analysis, FIFO, LIFO, normal loss, abnormal loss, it all comes down to this one simple, beautiful formula. This is the whole point of the chapter. Material consumed equals opening stock plus purchases minus closing stock. Everything we just talked about, every single technique, is designed to help us get the numbers for this formula perfectly right.